Welcome everybody to the Investment Committee meeting, Wednesday the 15th of November. I'd like to welcome members of the committee, staff, Peter and Jonathan from Ericsson Global, members of the press and anybody in the public arena. I'd like to open today's meeting with a Karakia Whakamutunga. Mai te pai maunga, rara ki te tai, mai te awa tonga, rara ki te awa raki. Tēnei te hapori, awhiai e taratahi, whanau, haramai te toki, huie, tākie. Okay, apologies we have from Councillor Lou Newman, who may come in online. We're not quite sure. She's in Disneyland, so that might trump this. Any other apologies? Okay, somebody like to move the apology for Lou Newman?
I'd like to move that.
Thank you, Steve Lawrence, seconded by His Worship. Thank you. All those in favour? Aye. Against? Carried. Conflict of interest. Anybody have a conflict of interest to declare? If not, we have no public forum, so we'll move straight to the minutes of the previous investment meeting, 23rd of August. Would somebody who was there like to move the receipt of those minutes?
I can move that.
Thank you, Councillor Lawrence, and I'll second those. Any questions or comments from the minutes? If not, I'll put them. All those in favour, please say aye.
Aye.
Against? Carried. Okay, report 6.1, investment update. Kelly on behalf of Kyra, and we'll have the opportunity for our advisors to come on in as well.
Thank you.
Thanks, Kelly.
Hello, everybody. So this is our standard report showing the position of our investments. This is reports as at 30th of September. And also identifying the movements in the investment since the initial investment. Attached, we have the report from Ericsson Global, and I will probably just take the report as read, and then happy to either take questions or pass on to Peter and Jonathan. They might like to some commentary. Whatever you prefer.
Well, I suppose just the question that I kind of ask each time when I look at the tracking of our investment, it seems to be continuing to only go one way. It's starting to look like my KiwiSaver investment, which loses money, and I pay the privilege for somebody to manage that loss on my behalf, which is a double whammy. I suppose my question, gentlemen, is at what point does an investment committee like this say, you know what, like where's the confidence for the general public who have just seen 0.5% of rates get lost by our investment decision? Help me out here.
Yeah, that's a very good question, Chair. And
Why I asked it.
And the answer is not yet, because the markets have been absolutely brutal since before you started investing, in fact. But that's why when we recommended these particular products to you, we picked low risk multi-asset income funds and Castle Rock, which is a long-term buy and hold private equity business. Now, the reason they have gone down, and the way your KiwiSaver has gone down the same way, is very simple. Since the end of 2009, when interest rates were very low, they kept going down until about a year ago. But then this year, this calendar year in particular, they've started going up very fast. And you can see that because the New Zealand cash rate was at 0.25%. It's now 5.5%. And that's a huge difference. And that's meant that if you held long-term government bonds or corporate bonds, under the accounting rules, you mark those to markets and use the current interest rate environment to discount those future payments, and you get a big negative amount. Now, the point is these are unrealised capital losses at this point. Interestingly, in the last quarter to the 30th of September, Castle Point was the only income fund that we have clients invested in which had a positive quarter, which just shows how severe the impact was. That impact continued into October, but then on the last couple of days of October, the markets around the world suddenly had a change of sentiment despite the war between Israel and Gaza. And the markets have gone up steadily since the last days of October till now, and they're still going up. So in that sense, what we're talking about is past performance. And this is a very long answer to your question, but it gives me the chance to say my piece, and then we can debate, or if there are any hard questions, I'll ask Peter Bahart, my colleague, to answer them.
Thank you.
But in that sense, I just want to give you two updates on your managers. Last week, we had an in-depth discussion with the manager of the Milford Diversified Income Fund. That fund had a negative return for the quarter and the month of October, but that product's running yield is 8%, and they're defensively positioned with a bond duration of 2.7 years rather than normal 3.6 or 4.2, depending on which bond duration index you look at. And they've got a very wide spread of small positions in shares all around the world, and their normal share exposure is 40%, but they've only got 30% in shares, and they've got 10% in cash. So they are very defensively positioned. And as I say, if you took the money out now, you'd have red ink, but you'd be giving up a return of 8% per annum on paper. Now, that return may, if the markets turn to custard, go down to 4%, or if you're lucky, they may go up further and you get up to 10%. But if you took it out, you'd put it in term deposits, and that would give you 6%. So, you know, all I'm saying is that's why you wouldn't take it out right now. Now, this morning, we had a 1.5 hour presentation from Castle Rock, and Peter grilled them about why they had the write-downs. And a lot of those write-downs were in the Tile Depot and Brooklands, which is their newest acquisition, the pet business. And the problem with Tile Depot is that they were importing a lot of tiles during a time when the supply chains were disrupted, and they had to pay 5 times the cost for shipping that they are paying now and what they had to pay pre-COVID. But they had to get the stock in case the building trade kept going gangbusters, as it did before these interest rates went up. Now things have stabilised again. They've got rid of that inventory, and the quarterly distributions, which are paid for from cash earnings that they've got from these businesses, are still going at the current rate. So you're getting about a 12% per annum or 4% per quarter distribution from that out of the profits of those businesses. And they assured us that they're not going to be any more significant write-downs of any of the 5 businesses they've got in the mix, right? So that one, whilst you have suffered a nasty 20% reduction in the capital value, you're still getting your income distributions out of profits going forward. And over time, as they're building their margins back up now, and over time, as the pressure on consumers eases, as we get used to this higher interest rate environment, those businesses will do even better. So in that sense, 2 out of the 4 businesses, the 4 products that you're in are looking very good. We're talking to Castle Point and Harbour as well on a regular basis, and they're doing what they can. The reason Castle Point went down was that the previous government decided to do a review of the emissions trading scheme, and their carbon credits went from $87 to $27 because the market dried up during the review. That government then subsequently reversed their decision to review it, and it's now $70 a unit, so that's gone up. And we think that their other investments in Australasian and global shares and global bonds and New Zealand bonds are holding up reasonably well. So in that sense, that one's going okay, as is the Harbour Income Fund. So whilst the timing of your entry into these markets, in hindsight, has not proved ideal, we've only dipped our toe in the water, and all the products that you're invested in are going to do better, probably than your KiwiSaver actually going forward for a little while longer, because they are good managers and they're picking good stocks. So in that sense, we're at the moment comfortable with the fact that the 31 December report should look a little bit better than you've seen to date. But of course, things could get worse geopolitically. The interesting one, and of course His Worship the Mayor will be interested in this, is to see how the new government gets on and where his former boss in New Zealand First ends up, because that will have a significant impact, we think, on how New Zealand goes as a country going forward, and as a result, how your investments do. Because it'll benefit everybody. Yeah.
Thank you. Yeah, that's pretty much the explanation my KiwiSaver people give me as well. But we still keep losing money. So I'll come right back to the question, really. I mean, because we only meet periodically as a committee, I guess my question is, at what point, I mean, you've just given an explanation, which I appreciate and respect, but then you finish by saying it should get better by December, but it may not because of all these other things. So what I'm seeking is, at what point of our meeting cycle should we be critically appraising these results and saying, you know what, we need to take a strategic decision to shift direction? Because, you know, each time we've met, we've gone negative. And if things don't, well, perhaps if I can ask a question before you answer that, is if you're updating our portfolio today, which you probably already have, what would we be looking at? Because that takes should into is.
Yes. So we watch all our clients, investment managers, like a hawk when we watch the markets 24/7, right? We are being asked by a number of clients at the moment for exactly the same reasons, your question, and our answer is the same. You should not get out of the markets and make a strategic decision at this point, because the costs of crystallizing your losses are greater if you get out now than if you keep the money invested over the next season. Now, the markets are the worst and most brutal they have ever been in the whole history of investing. But rest assured, if one of your managers changes its strategy or loses its intellectual skill by carelessly having, their best portfolio manager run over by a bus or poached by somebody else, or if their governance system breaks down and they start fudging the books or getting inappropriate outcomes, then we'd email you, we'd email Jeff and Terry straight away and say, now's the time to get out. But if we were setting up the portfolio today, we'd still recommend these products going forward. That's how much confidence we have in these particular managers and products.
Yeah, I might just add, so, we're 11 months into a long-term investment strategy, and what an 11 months has been, but if you have a look at the managers, Castle Point effectively over that time has preserved capital, which is essentially what we want a multi-asset fund to do when things get really bad. If you're not in a multi-asset type fund, then when equities go down, bonds go down, you go down. And we've seen with Castle Point their ability to actually preserve that capital. Same with Harbour. Harbour has managed to eke out a positive return over that time period. Castle Rock, as Jonathan mentioned, the downgrades and valuations over that time has been severe because of what's been happening. But the thing is that these are profitable businesses pushing out cash at the rate of 10% plus per annum. So all it takes is a hold. You don't have to worry about a valuation increase, just a hold in valuations, and those returns are going to start coming through. Certainly the indication they give us today that would be the case looking forward. But these are markets, they are unpredictable, so we always have that caveat. But the expectation is that this portfolio is structured to produce good returns going forward, and then over the longer term it'll be making up for the losses that unfortunately we suffered in the early stages.
Thank you. So really what you're saying, Jonathan, just before, is that regardless of our meeting cycles and our processes, if you feel or when you feel that we need to make an immediate change, you enact that straight away.
Yes. And just to give you a real live example of that, we had a client in a Credit Suisse product, and we got them out of that Credit Suisse product in December last year. Now, we didn't know what was going to happen to Silicon Valley Bank and subsequently to Credit Suisse, but effectively we got out in advance. Now, the timing wasn't coincidence, but we didn't think it was going to happen that quickly. But the point I'm trying to make is this is part of the service that you get from us. It's not, we don't set and forget. We continually test and reinforce what we're doing. And that's why we have these regular meetings with the fund managers that we use, so that we can actually check, eyeball them face to face and see, if they're looking stressed and hassled and everything else, well then, that gives us a warning sign, and then we'd go into their office and kick a few more tires. Or I might even ring one of my mates who might just happen to be on the board or somebody who knows them well and just check on something else.
Yeah, that's good, and I appreciate you articulating that. I guess from where we sit as elected members, we're representing stressed and hassle ratepayers who and investing their money on their behalf, and we treat every dollar of this investment as though it were our own, and that's our role. Thank you, gentlemen. Councillors, Your Worship, any questions or comments of our advisors?
Talking about Castle Rock, you mentioned a 20% write down, but we're looking at 7.4 since inception. Is that? Can you explain that?
So essentially, if you take the capital write down and then add the income, you end up with your return. So the income has been very good, but unfortunately, it looks pretty bad because of the capital write down.
And that's the capital write down is done because these are all private companies, so that's not reflected in the share market. So who's determining those values?
So Castle Rock essentially is determining those values with the support of valuers. So they actually have, we had the accountant in here today as well to talk through the valuations of the companies. So they'll make an assessment in terms of the future viability of the business and the future sales and prospects and what's happening in the market. And they gave a full rundown in terms of the domestic economy and what was happening with, as Jonathan mentioned, supply chains and that sort of thing. And then we'll determine a fair value for that asset for the portfolio. They've been quite conservative in the way that they've been assessing the valuations, which is actually comforting.
Yeah, and they're all these funds, I mean, these things are audited, the businesses are audited. So it effectively is a set of chartered accountants who sign off on them. But then, of course, obviously the directors have to agree with the valuations as well.
But if the cash flows are continue to be quite good, that feels a bit tough.
It is a bit tough, but in that sense, you're getting better disclosure than you do from some of the big listed companies where they've got a lot more creative accounting, from their CFOs and things. I mean, these are businesses that have been privately held for a long time.
Not you, Kelly.
I apologise.
We're just processing all of those technical terms you're giving.
Yeah.
No. It is actually very, very interesting to see how open and honest. One of our colleagues was in the meeting with us, and she said, she hadn't met the Castle Rock guys before. She said, they're amazingly honest talking to you. They're not like the normal fund managers, are they? But in that sense, we do try and dig into the weeds a bit and find things out. And I think what's happened to them is that when they buy a private business, which has been, it's a family business. In case of Majestic Horseplace, it's been going for 80 years, and the previous owner is still on the board. And so they're just trying to do the right thing by their investors, and the write-downs are effectively to reflect the adverse trading conditions that these higher interest rates are causing the whole country. So in that sense, yes, they're being conservative, and yes, ouch, it hurts, especially if you think it's permanent. But over a 3-year period, that will come right.
Thank you. Councillor Gallen, Your Worship. Jeff, any?
Kia ora, Jonathan, Peter, this is Jeff here. Hey, I just had a question on Brooklands. So recently acquired by Castle Rock, so new investment, and then we go through a write down. So obviously, when you had a conversation with them, you talked to them about their due diligence process they went through in the acquisition, and how do we acquire something and then go through a write down process? That that would seem to me that there's something wrong with the price that was settled on, or maybe there was something they didn't capture during due diligence. Can you just talk me through their feedback on that?
There was a little bit of feedback, Jeff, around what happened to their major client, which is Animats. And what happened to Animats is that when a lot of pets and pet products are discretionary spending, and with people's wallets getting under pressure with food costs in particular, but also mortgages, the amount of spending that customers of Animats did, which buy their stuff from Brooklands, reduced. But not only that, Animats, because it was feeling the pinch a bit, actually went and reduced the product lines that they were buying from Brooklands. So it wasn't so much a function of the due diligence as their major clients' reaction to the change in interest rates, which they then reflected in their revised valuation. The due diligence process was sound, and it was based on the earnings and the current view of the business in the market. But as I say, that particular coming out of COVID, it was tricky anyway. And I think, yes, in that sense, during COVID, a lot of people were in lockdowns and stuck at home, and so they got their pets and pampered them a bit because they had the cash to do it, because they weren't able to spend a whole lot of stuff out. Now, that I'm talking from an Auckland perspective, where we were locked down a lot. It was less in other parts of the country, especially in the South Island. But in that sense, as I say, it wasn't so much the due diligence that was at fault. It was them reacting conservatively to their biggest customer, if you like, reacting to its cost cutting from its customers. And as I say, this means that it is reflecting the reality of these New Zealand businesses.
And they've got a new CEO.
Yes, they're appointing a new CEO actually at the beginning of December, who comes from a vet background, and that's because Ash, who's the current CEO, is turning 65 and wants to pull back from the business and basically retire but he's available part-time to work on the business, for the next 6 months or so if he's needed. But you see, that'll give Brooklands the opportunity to get into a whole new sector because this guy comes from a veterinary background. And so they can add veterinary services and supplies to the animates range and help develop the thing. So that's another positive, we think. Yep.
Yeah. Okay. Thank you.
What are their brands, Brooklands?
I don't know. I mean, they mainly do tropical fish, and they do that for animates, and they do it for Auckland Zoo.
Okay.
And but also
so it's not dog food, which is what.
Well, it will be dog food, but no, it's more the other appliances and things. So the grooming things, and apparently they've got 1,100 lines of product that they put into animate stores, and animate said they wanted to cut that by 20%.
Your Worship, you had a question or a comment?
No, I take it, clearly we have money sitting and on call and invested on term deposits. And so what you're not confident enough to say that we should be putting more money into this investment, eh?
No, we're not. We're saying 6% on term deposit in the bank is better than an uncertain investment. So I said the Milford Fund in particular, which is the newest investment you've made, its running yield is 8%. But we recommend to you, and we're recommending to new clients as well, you have a portion in the markets that it's in, but in the short term, we're saying keep the money on term deposit. And in that sense, you can get 6% on 6 months or a year. And we say lock that 6% in for a year. And in some clients' cases, we're saying even lock it in for 3 years. Now, we're not saying that in your case, because I think you don't want to lock term deposits away for too long, because you might have liquidity issues. If all your ratepayers pay their rates, you won't have any liquidity issues. But, some of them are struggling, I suspect, as well. So, you've just got to be careful with liquidity.
Yeah.
But in that sense, there's a number of critical geopolitical events. I've vaguely mentioned one of them, which is that, we're still waiting to see what our new government is and how it's structured, because that will have a significant impact on the morale and the way the nation of New Zealand goes forward. Secondly, you've got Premier Xi and President Biden meeting in Beijing today, and that could hopefully be, helpful. But if it goes the wrong way, then things could get messier. But of course, you've also got the problem between Israel and Hamas, and that war is dragging on. Everybody's saying it should stop. But, you tell the Israelis that, and you tell the Hamas fighters that, and they'll just laugh at you. So, in that sense, the war in Ukraine is still going, and it's getting pretty grim, and winter's coming there. But that actually affected Tile Depot, funnily enough, because they used to get quite a lot of Italian tiles, but a lot of the clay that the Italians used to make tiles came out of Ukraine. They can't get it out anymore. So the proportion of Italian tiles that Tile Depot sells is less now than it was before the war in Ukraine. So all these global things will have an impact on us. And it's a question of spreading the risk as you have between 4 very different managers that are exposed to different parts of the market and going forward. But at the moment, stick to your term deposits, Your Worship.
Actually, I can just ask that previous question too. Brooklands has 20 brands, including one of the brands, API, that I spend a lot of money on my tropical fish tank. So that's the one I know the best. And there's quite a few dog and cat, Easy Dog and Pet Rages, Precision, Blackmores, Nylabone and so on, as in that whole suite of products.
There you go, Steve. You're much more informed now.
I understand there's a lot less pet manufacturers in New Zealand now. It's all important. Most of it's imported. And you think, well, you know, you think the pet food would be booming, you know.
Yeah.
Maybe our ratepayers might have to eat more of it.
Oh, I hope not, Steve. No, come on. Not Carlton, surely.
Well, if they bought them for their pets, that would help. Yeah.
Those big Tux biscuits are hard on your teeth.
Soak them, got to soak them first.
Okay, right. Well, thank you, gentlemen, for that. Kelly, have you got anything you want to conclude with?
No, I suppose just I was going to echo the comment that we're not planning to invest anything further at this stage, but the wait and see over the longer term, the investments continue to perform.
Well, I'm comfortable with the gentleman's advice and explanation and update. So thank you, gentlemen. On behalf of the investment committee, we this is our first dip the toe in the water for investment for this council. So there's a lot riding on it for us. And, you know, we want to be able to make sure that this is an important part of our business going forward, but it has to deliver. And so, you know, really feeling the pressure of that.
Yes, and through you, Mr. Chair. Look, I think what I try to keep in my mind is this is not our core business. We're not an investment company.
Yeah.
We're not here to play the stock market. We're here to provide infrastructure for our ratepayers and services for our constituents, broadly speaking. This is a must-do with the reserves that we have to manage responsibly. But it is always going to be a balance between what we have to do to meet the infrastructural challenges coming at us and how we can best utilise this money, whether best utilisation rests in it being in investments, returning, giving us revenue stream inwards, or whether it's best utilised on core infrastructure elsewhere. And it's about getting the best opportunity gain at the time that we can. That's my point.
Thank you, Your Worship. Okay, we have a recommendation, page 11, that we receive the report. I'm happy to move that. Seconded by His Worship the Mayor. All those in favour, please say aye.
Aye.
Against, carried. Thank you. I've just got a. Sorry, was that a question?
No.
Just as we wrap up the investment committee meeting, I just want to acknowledge the contribution of Kelly, who leaves us. We've got a lovely morning tea. Sorry, gentlemen, but we'll have a cake on your behalf tomorrow. But just want to acknowledge, because Kelly has been instrumental in the establishment of the investment committee and helping connect us with the expertise and also bringing the advice in a timely fashion to the committee. So just want to thank you, Kelly, for everything that you've done and wish you all the very best for your future.
Thank you.
And lastly, I just want to put to the committee that I'm proposing that we invite Marty Sabaya as a co-opted member of the investment committee. Marty is a former finance staff member of Carterton Council. He's now a member of our wider community. He's actually a Hurunui-Arangi Marae representative on our Risk and Assurance Committee meeting, which we had this morning. And just with his broad experiences in both finance and connected to tangata whenua and also the wider community, just his wise counsel, I feel certainly I'd like his contribution around the table. I had a chat to him after the last meeting and he can't make it physically, but he'd like to be online and just provide input as and when. So if nobody has any objection, I'd like him to be invited to be a co-opted member on the committee. All okay with that?
You need a resolution?
Yeah, I'll move that. Seconded by His Worship the Mayor. All those in favour? Against? Carried.
Done.
That's it, ladies and gentlemen. I shall close with a Karakia Whakamutunga. Kia tau, kia tātou katoa, te atawhai o te tātou, ariki a ihu karaiti. Me te araha o te atua, me te whiwhi nā tahitanga ki te wairua tapu, aki, amini. And that means settle upon us with the love of Jesus Christ, the love of God, and the union of the Sacred Spirit forever and ever. Amen.
Amen.
Thanks, gentlemen.
Thank you, Peter. Thank you, Jonathan. So
Thank you, team. Oh,